Hello, my name's Josh, and these are some quick thoughts. This is going to be a bit new for me. I'm trying the picture-in-picture thing with my dual screens, but I wanted to give my quick thoughts on Facebook as well as how I value companies, and especially on the valuation side. So we're all aware of Facebook, but there was recently news that Facebook wanted to rebrand the company. So as many people know, they know Apple, but or sorry, Google. Google actually, the stock is called Alphabet. And Alphabet's the holding company, and they own a bunch of different companies, one of which is Google. So Facebook's trying to do something similar where they own other properties, so not just Facebook, they own Instagram, they own WhatsApp, they own the VR company Oculus, and they want to change the name Facebook. It's mainly a branding exercise because they want to, there's obviously some negative press recently around Facebook, and not just that, Facebook is somewhat of a tired um, media property. Most people now think, oh, Facebook, my parents are on there. Instagram's the sexy one, so they definitely want to shy away from Facebook and lean into their more growth-oriented media, such as Instagram, maybe even Oculus. I know VR is growing, but it's still a very small part. And WhatsApp, which is very large and elsewhere in the world. So that's some recent news. So I thought it was a good time to discuss Facebook. Full disclosure, I do own Facebook shares. And as I've discussed before, I have a three-sided way of evaluating companies. So one is product. I have to understand the product. I likely should be a user. I have to see the value prop. There should be people who are fanatical about it, use it all the time, love it, or are addicted to it. Something like that where people really need to see value in the product. I won't invest in something, or rarely will I invest in something where I really don't understand it. I've done it before, and I made some money sometimes, and I lost some money sometimes. So I want to put myself in the best position to succeed, and I think you have the best odds are when you understand the company, especially deeply. If you are in healthcare and you deeply understand something in the healthcare industry, maybe you have an edge over everyone else. That's an old Peter Lynch, who's a famous investor. He said, you can beat Wall Street if you put your chips in an area where you understand. If you're at the mall all the time and you see a store is getting really hot because there's this new brand, maybe that brand, you might notice it before others. So I try to always understand the product. Obviously, everyone knows Facebook, and I understand it well. I actually don't use Facebook or Instagram very often personally. I have used it. I understand it. I used to use it a lot. I stopped for my own mental health, but I've also now used it as a advertiser. So I've done Facebook ads for entrepreneurial work that I did, as well as for the company I work for now. So I deeply understand it. So I see the value there for sure. I understand the product. I know people really do use it a lot. So it's a very sticky product. So product, check. The second is the macro environment around it, or are there tailwinds, is how I often think about it. So, is it, I always use the example of, I previously invested in a nursing home REIT. So a REIT is a real estate investment trust. And so they owned the properties where nursing homes were. So I owned that because I knew the population was aging. And so that was a demographic shift. So again, that had tailwinds behind it. And so that's why I invest in that. Now, I didn't yet have that framework, but that did actually was a pretty good investment at the time. So I do want to understand what's the macro environment around that. So obviously right now, Facebook is almost everywhere. But it's not the best macro environment because there are some regulatory risks right now. There's obviously been some negative press with Facebook, but at the same time, it's everywhere. I think that there is going to be a growth in some of they're very into VR, which is why they bought Oculus. I think that is a growing industry. I think that is going to be much bigger. And lately they've been trying to rebrand themselves as not just for the other reason, but they keep trying to call themselves a Metaverse company. Now, what is the Metaverse? It's kind of the digital world we live in. Now, right now, the digital world we live in is, it's all text, mostly text. You say, hey, and you have a digital persona. That's your Facebook profile. But this is going to become even more so. There's games like Second Life or Second Sim, I think maybe it's called. And a lot of people think we're going to live more and more of our lives digitally, and it's going to become the digital world's going to become even more like the real world. This is a big part with crypto, with NFTs. People want to, just like how they have Gucci in here, they want a digital, or maybe a better example is Fortnite. Why do you have a skin? Why do you wear a specific skin in Fortnite or get a cool hat? Because they want to show off, just like how they want cool shoes in real life. So that is a big part of the digital, what they're calling the metaverse is people want to do that, and they are very well positioned to benefit from this shift to what people are calling the metaverse or Web 3.0. So I do think they have some advantage there, and obviously more and more people are going online, so there's advantages there. And you could even argue that right now most of their profits come from the U.S. and developed countries. As more and more of the world um, gains in income, they can monetize those users better. So there are some demographic shifts working in their favor, some not so, but there are some positive tailwinds. Maybe they're light. And the third element is valuation. So is it a great product? Is it benefiting somehow, or at least not actively getting worse from the environment? And the third thing is, okay, it's a great business, but is it worth what I'm paying for? Um, would I buy this company if it was 10 times more expensive? Probably not. So we need to get a value framework. Now, the gold standard for valuation is what's called DCF, or discounted cash flow. Basically, you're taking all the cash the company will produce in the future and you're discounting it to today. And that way you can kind of understand, what is this worth if I just held it and kept getting cash from it. Now, obviously, you make assumptions. What's the growth rate? What's the margins? All that. There's a lot of work that goes into it. Now, for stable companies that are cash flow positive, you can do it, and it's actually pretty accurate. But for high growth companies, or companies that are going through fluctuations, or companies that are currently money losing, there's much more variance in your DCF, because your DCF is really telling a story. That's what Aswath Damodaran talks about. Your DCF is telling a story. What's the growth rate? What's the margins? How are you getting there? And so it's obviously very useful, but it's a lot of work to do. And again, at the end of the day, numbers in a cell are going to tell you if this is a good investment or not. You kind of have to understand the business again as well, but it can give you a gut check. So I do use DCF sometimes, but I actually like this here, which I'll show you, which I think is a better gut check of valuation, or easier to understand. And so what this is on the left here, we have growth rate, and across the top we have margin. And here we have revenue and market cap. So this is for Facebook. And so last year revenue was 104 million, and the market cap currently is 960 million. And here we have a 10-year, I developed this myself. It's basically, if you get these margins and growth on average for the next 10 years, what is your expected return per year? So 7.4% isn't 7.4% over 10 years, it's per year. So it's called a CAGR, compound annual growth rate. So the stock market returns on average about 7%. So I want to beat that. I'm aiming for 10 to 15%, probably 12.5 is my actual aim. But I also try to always I'm not a value investor, but I try to always look from a value perspective. So I want to buy something that's discounted. I don't want to buy something assuming the most aggressive assumptions. Oh, because you can make any company look good. Oh, look, if this company grows at 100% for the next 10 years, it's going to make a ton of money. Yeah, but is that realistic, right? Obviously, if it is realistic, then it's going to be a great company. But what if it grows slower than you think? What if its margins are bad? What if costs go up or something like that? So this is really why you need to do this. So again, it's growth and margin. And when I'm talking margin, I typically look at operating margin. So there's gross margin, which is how much I'll use a t-shirt as an example. So when you produce a t-shirt, let's say you sell it for $10, what was the threads to produce the t-shirt and all that? So that's the input costs. So that would be, when you subtract that out, that's the gross profit. Then there's other expenses, rent, and maybe the machines to buy it. So all that, rent for the building where you sew the shirts. So that's operating profit. So operating profit is after you take out all the other expenses, sales, administrative work, you got to pay an accountant, all that stuff. And then there's also something called net profit, which is after you also take out taxes. So let's look at Facebook. So again, this is the growth in revenue. So 104 That's based on their revenues from last year. And we can see here what their growth rate was. I like this site, Macro Trends. So last year they grew their revenues 40% year over year. Before that it was 21%, 26, 37. So these are huge growth rates, massive. But are they realistic to keep growing? As you get bigger and bigger, it gets harder and harder to grow at the same rate. So, and again, we want to be conservative. So, you could say, oh, look, if it grows at 40%, I don't even have 40%. If it grows at 40%, let's also look at margins here. So it's software. So the gross margins, again, what's the input cost? Servers and stuff like that. It's pretty low. So it's a very high margin business. Operating, they pay developers, they pay for marketing, all that stuff. So this is still extraordinarily high operating profit, but it's basically fluctuated between 50 and 35. Again, it was way lower here, but let's say lately, that was in 2014. It's been about 40 to 35, and lately it's been 42. So let's take a little bit of a conservative end, and let's say it's 30%. Well, if it grew at 30% and kept going 30% revenue growth like it was previously, again, it was 40% last year, 21% the year before, this is a huge win. 27% a year is massive. But again, we want to be conservative. Actually, you could say 35 because it was, last year was what, 42% operating profit. But we want to be conservative. So let's say it only has margins of 30% because there's some regulatory headwinds. And let's say that those regulatory headwinds also significantly slow its growth, like way, way slow. So instead of growing at 30%, mid-20s, it has to grow at 10%. Even at 30% and 10% growth, you're looking at about a 7.7% compound annual growth rate, which is better than the market. A little bit, but it's still better. So even if I look conservatively, it looks like a really interesting buy that would probably do okay, even if things break poorly. So to me, this is it's a high value growth company. And again, could things go wrong? Obviously, there's regulatory risks. Maybe just people think it's lame. Maybe the government changes some stuff and breaks it up. There's a lot of things that could go wrong here, but that's any investment. You're trying to put your thumb on the scale, and you can't predict the future, but you are trying to put yourself in a position where there's more things that could break right. And if they do break right, you have a lot of upside. Look at all that green there. There's lots of ways this could work out. If there's higher growth rates, maybe the metaverse thing works out, maybe it doesn't. But to me, this is a company that's a great business, spitting out cash, and it's also has lots of potential upside. So I've been a buyer with these regulatory headwinds. I've been buying more and more. Not too much because, again, I do want to keep my exposure fairly balanced, but this is a bit about how I see Facebook and also how I value companies. So I look at this through kind of an idea. And again, obviously, if margins plummeted and growth fell, you get a huge loss, but I don't expect that to happen. But you do always want to say these are what is realistic. So yeah, this is my name is Josh Lipton, and these are my quick thoughts on Facebook and valuation.